Hi, in this video we'll be discussing with Aniruddha Nahe, discussing at length about his experience in the industry and the process flow as well as the fund selection process which has been followed in PGIM.
And slightly about yourself, on this.
Sure. So again, thank you there. Thank you to you and your team. I've been in this industry for almost 2 decades now. Started my career with DSP as an analyst, uh, and then I moved on to become the fund manager for DSP BlackRock Microcap, which was then called the Microcap actually. Then 2010, from between 2008 and 2010. 2010, I got an opportunity to move abroad with Mirai in Hong Kong. So I was with them for about 3 years before coming back to India. I joined IDFC Mutual Fund, and I used to manage their IDFC Sterling Fund and the IDFC Tax Advantage. Uh, in the Post that, for a brief stint, I was heading the PMS of Avendus before joining PGIM in the month of April 2018. Since then, I have been managing two of their funds, the PGIM India Mid Cap Fund and the PGIM India Diversified Fund.
As you can see, it's a very vast experience which Aniruddha Nair holds in the industry. Let's hear from him. What are his views and his thought process before selecting a stock, and in general viewpoint of the market itself.
Diversified equity, which is the stellar performer, if I'm not wrong. I think large cap is the one which has done really well for you. After that, it has gone to, I think, diversified equity. I think it is amongst top 5 funds, if I'm not wrong, diversified equity in the this thing.
I frankly haven't tracked it, but it has
strategy or the behind the portfolio allocation of yours, sector wise or something.
Sure. So the multi-cap fund, which is the diversified fund, is a multi-cap fund, and we have been true to the sense of pure multi-cap in that sense. We've had decent allocations towards the mid-cap and the small caps. Our large cap portion in the diversified portfolio has always been between 50 to 60% average. The rest of the fund has always been allocated towards mid and small caps. Our only sense is over the next 3-5 years, the mid and small caps, there would be a lot of value unlocking that can happen, and a lot of value creation that can happen. And hence, we've always given a decent weightage to the mid and small cap space. One thing that we've always been conscious about is we look for businesses which have very strong operating cash flows, not just in 1 year, but in 70% of the time that the company is in business or in its history. So that is one focus, positive operating cash flows in 70% of the time. The second thing that we focus on is on clean balance sheets. We don't like businesses which have too much of debt on its balance sheet. And third is there must be no major corporate governance issues.
So I have observed in your portfolio, actually, you have cautiously selected stocks which have low debt to equity ratio, actually.
Yes, we've been very conscious on that. And hence, to that extent, also financials being the highest debt to equity businesses, we have a decent, we had a low allocation to financials also to that extent. But generally, if you look across sectors, we don't have companies which have too much of debt.
So in this particular segment, how are you placed when it comes to financial? Are you going to reallocate or rejiggle your portfolio so to make sure that you will get more allocation into your banking now? What I've seen from the recent portfolio, I think you have this allocation is something in the tune of around 22-23%, if I'm not wrong, right? Banking as a sector.
So financials as a sector, yes, but in financials we have a decent weightage to insurance also, which are businesses which don't have leverage, frankly speaking. So that is something that we like. But financials, what is interesting, what has changed is the fact that they've been able, a lot of these good financial businesses out there have been able to raise capital in the month of July, approximately July August is what I remember, and that has increased their capital adequacies. So that has changed our stance, and frankly, the recovery that we are seeing all around has been far ahead of expectation, and hence to that extent, we think the asset quality issues which the industry was fearing might not come across to those levels. So you've got on one side capital getting raised, and on the other side the asset quality might not play out as badly as one was expecting, and hence we have started allocating more towards financials.
Oh, what do you feel going forward? Maybe the sector or the sector to look after for something like that will be the next performer or something like that, which you would be looking at like.
So we think from a stability and earnings perspective, stability and visibility of earnings over the next 2 3 years, IT is something that we really like. We think clearly because of COVID, the kind of change that was expected to happen probably over the next 5 6 years in terms of adoption of digital and cloud, etc., in the Western world has happened in the last 5 6 months, and hence to that extent. Their implementation part, a lot of Indian IT companies should benefit out of it. And so that is something, that is one sector where we remain very confident in terms of earnings growth. The other place probably is given where financials are in terms of valuations. I think some of the downside for financials might be pretty limited, and hence financials also should start contributing to the market returns. They have already done them. Only thing is, I don't think financials in terms of valuations can go back to the kind of valuations they were pre-COVID.
Sector again, we have financials as a whole. If you're taking in that, we have banking, and we have NBFC, and then we have insurance and mutual funds and broking this thing.
Right.
So, what do you feel is the next in this particular subsectors like?
See, frankly, we break it down between lending and non-lending financials. So, non-lending financials have not corrected too much. In fact, they have been very stable and they have decent growth prospects. Over a longer period of time, on the non-lending side, insurance is something that we remain very positive. The only problem is, as I said, the valuations have not corrected, and hence getting a big PE re-rating for these businesses might be difficult. But they will be steady compounders. On the lending side, I think so a lot of businesses have corrected decently enough in terms of valuations, and hence when the economy slowly starts coming back to recovery mode, I think in the near term, you would have these non-lending businesses performing really well. The lending businesses performing very well.
Okay, so what do you feel would be the new PE for the whole financial?
That is, see, this is something that we always say. We as analysts or fund managers, we all have always focused on what is going to be the earnings going to be like, or what is going to be the book value like. What is the PE going to be like? We leave it to the markets to determine. I think even as a fund manager or a analyst, I wouldn't be a competent person to give a PE or allocate a PE to it, assign a PE to a sector, because I think PEs are completely determined by markets. If they really like it, they can push up the PEs. If
There's one particular, I'll just give you an example. One particular case wherein most of us have decent exposure. Most of the fund managers have decent exposure. Who has, who has a multiple, what to say? It cannot be fit into one particular sector. So, which was earlier petroleum. Now it is mostly considered as a telecom stock. So, what do you feel as a how do you reassess a situation wherein, because petroleum is actually average PE something in the tune of around 8 to 10 or 11, 12% is what usually valued at, fair value I'm saying. Whereas when it comes to telecom or this thing is valued at something above 50, which is a fair value is what people say, 50 and 60 something that 40 to 60 is what they say. So what do you feel, which has a mix of all this? How do you feel to assess a new PE or something like that? Because some of the stocks are still, which have a mix of all this, is valued at something around 23, 24 PE, if I'm not wrong, right? So
Sure. See, our only sense is for businesses which have different characteristics in them, or a sector probably, or a business which has presence across sectors. Let's say, what determines a valuation is the fact that what is the kind of uh, top line, EBITDA, and profitability a business is drawing from each of these businesses. If the contribution is higher from businesses, something like telecom, digital, etc., where you have a sustained structural growth in India because of the data consumption that is happening and the digitization that is happening, these businesses will invariably get a higher valuation. Whereas businesses which are probably the more old economy businesses, uh, there, frankly speaking, given the fact that oil and gas, especially, the demand is slowly over the next decade, this demand is going to fall off as, let's say, renewable power or renewable energy gains traction. That is a sector where you might not get majority of a decent PE rating happening. But incrementally, if larger part of businesses comes from the newer end of the business or the newer businesses, I think the valuations for the companies, eh, any business would be determined by uh, what is the valuation from the more modern businesses, the more structural businesses, and that would drive valuations.
So it's predominantly like the percentage of earnings coming from one particular.
Absolutely,
Right. So,
absolutely.
so do you at any point of time will you consider book value also, or just earnings is what P is what
No,
matters?
so P actually doesn't matter to us. What we look for is clearly PEG, which is PE divided by earnings growth. And our philosophy, and that is what we say GAP, growth at a reasonable price. We never focus on PE. Our focus has always been on PEG. And in PEG, what we try to do is we find the PE divided by the next 3 years earnings growth. And if it is nearer to 1, we go ahead and buy that. If it is nearer to 2, we go ahead and sell that business. We do look at book value, but we use the book value more for businesses like financials. And in a year like this year, where earnings is very unstable, at least the book value gives you a lot of stability at that point of time, and hence a lot of businesses in this financial year has been valued on price to book.
Now you know about the viewpoint from Aniruddha Nahe himself. Let's also understand about the process flows of the company as well as fund itself from Aniruddha Nahe.
Yeah, sure. We wanted to highlight something which is basically what our process has been, and this is something that has really helped us, be more objective in selecting stocks, and it has helped in reducing mistakes for us to that extent. And that is one of the things that we keep, we are very proud of. So what we do is in the process we start off with our cash flows, focus on cash flows. Any business that we look at the history of a business and try to see that at least any business which is getting coming into the universe, it must have positive operating cash flows in 70% of the history of a company. So if the history is 10 years, 7 out of 10 years must have positive operating cash flows. The second thing that we looked at is clean balance sheets. So net debt to equity has to be less than 2. And the third thing that we look at is there should be no major corporate governance issues. These three things put together has ensured, especially the balance sheet ratio and the cash flow ratio. These are very objective ratios, and hence, irrespective of what an analyst or a fund manager thinks about a stock, if they do not fulfill these two criterias, which are very objective, they don't come into the portfolio.
Do we get with a debt to equity of 2? Do we get enough stocks? Is what is.
Yes, yes, boss. There are enough businesses in India which have a net debt to equity of less than 2.
So you
The
will have
IT,
challenges sometimes, right? Maybe if it is by a little bit more, also you may feel the value creation may happen with that stock, but still you
yeah,
will
see, but
neglect it, is it?
see, not that. See, when I'm saying net, I'm not looking at gross debt to equity. I'm looking at net debt to equity. So gross debt to equity might still be higher, but if it has cash, it gets deducted from your gross debt to that extent and brings down the net debt. The, if you look at the good businesses in India, the IT sector, the pharma sector, the auto ancillary industries, a lot of them actually the complete industry fits into this segment. Agrochemicals
IT,
and chemicals.
obviously, yeah, it will come.
Yeah. So I think the only industry which doesn't fit into this in any way is your lending businesses, financials, but we don't uh, judge them on the basis of this criteria for financials.
Absolutely. No, and in fact, I basically just wanted to say that, obviously there is a ready reckoner that we keep talking to, people about, and where, the whole essence of, the portfolio management that we as a fund house has been doing is to, try to have as minimalistic overlap with the index in the best possible way, and also to look at, trying to have a minimalistic overlap, at least with competing funds. I mean, so to say, it is not that it is conscious. It is just that the portfolio pick and the construct has been such that when we observed it, we realized that the overlap that we have even with the index is hardly under about 30%. And hence that really shows that somebody who's getting into good product portfolio will definitely have the benefit of participating in a reasonably good rally as well.
Yeah, so it was a very healthy conversation, actually. So to be frank with you, Anirudh, thank you very much for giving insight about your funds. So same with Rakesh.
Thank
Thank
you.
you. Thank you very much.
Himself.
Thank you.
If you have the conviction what Anirudh and I holds for his fund, and if you want to invest in this fund, we would recommend you to invest by downloading our app ECSMF, which is available in Apple as well as Google Play Store, which you can also download using our website www.ecsmf.com. Please do like, share, subscribe, and don't forget to download our app.